You know that the Federal Reserve will be increasing their benchmark interest rate, which means that even more money can leak from your pocket. So if you are under consumer debts and have not planned to clear them off, then you need to hurry up because the Federal Reserve is all set to increase interest rates. This is going to have an effect on you one way or the other if you're under consumer debts. But you may be wondering, how does this interest rate increase impact you and what you should do to financially prepare yourself? Well, don't think about it too much because in today's video, we're going to explain everything about the impacts of an increase in interest rates and what money moves you should make. By the way, if we haven't met already, I'm Joe and I love to make videos regarding personal finance, investing, real estate, and life topics. If you find any value in this video, do me a favor and smash the like button. It really helps me out. Federal Reserve Chairman Jerome Powell said recent inflation was uncomfortably above the levels the central bank seen. Powell stated there's a shock going through our entire system associated with the reopening of the economy, and it has driven inflation well above the recommended 2%. And of course, we're not comfortable with that. So U.S. consumer prices continue to accelerate in June at the fastest pace in 13 years as the recovery from the pandemic gained steam. Matter of fact, the Labor Department's Consumer Price Index increased 5.4% in June from a year earlier. Now, excluding volatile food and energy categories, prices rose 4.5% from a year earlier, which is the most in 30 years. Powell also stated that the challenge we're confronting is how to react to this inflation, which is larger than what we had expected or that anyone had expected. And to the extent it's temporary, it would be appropriate to react to it, but to the extent it gets longer and longer, we'll have to reevaluate these risks. Alright guys, so with that being said, it's being assumed that the Federal Reserve is going to raise interest rates, which means now your consumer debt payments are going to surge as well. You would be amazed to know that the total household debt in America has reached a record $13.15 trillion, and about $834 billion out of that total is consumer debt, including credit card debt. Now, first things first, let's talk about what is the impact of the Federal Reserve increasing interest rates. So Federal Reserve Chairman has said that for some time the central bank will keep interest rates to zero no matter how much progress the U.S. economy makes. Now, what he really meant is that for the time being, the Federal Reserve is allowing everyone with consumer debt to clear up the debts before it's too late. Now, many of us would take this statement as something trivial, but this is not less than a warning from the Federal Reserve as the interest rates are not going to stay low forever. I mean, if you think about it, guys, we've seen that the world was shut down due to the pandemic, and specifically in the United States, inflation is rising. Inflation is raising its head once again, and due to this inflation, the Federal Reserve has given us a hint that an interest rate increase can hit us anytime in 2023, which was previously 2024, according to the most recent estimates. What it really means is that now is the time to take some effective decisions to clear up your debts and take loans from either your home or anything else, because sooner than later the interest rates are going to start to climb. But let's say you didn't do anything and the interest rates have been increased, then what will it really mean? So if you're using your credit card and carrying a revolving balance, then this is the first place it's going to hit you really hard, because the interest rate hike will make your payments go up. Let's say, for example, you use your credit card and make transactions of about $10,000 per month. And let's say that the benchmark interest rate increases to 1.5 to 1.75. That will add an extra $25 to $30 in your debt payment that you need to pay every single month. If that doesn't sound like much, then consider the total will be an additional $300 plus an additional interest rate payment every single year. To understand it better, let's suppose that you have an adjustable rate mortgage or ARM on a $2,000 home. That interest rate increase will add an extra $30 to the total debt payment per month. That makes a total of $360 per year. Now, if you have a fixed rate mortgage, then you don't have to worry about paying extra as a result of this interest rate increase. One thing to keep in mind, guys, is that someone who ends up taking a loan on a house after the interest rate increase will end up having to pay more interest in the long run than someone who does so now. Alright, so let's talk about what you should do to financially prepare yourself before the interest rate increase. So my very first recommendation is to consolidate your debt. The pandemic has affected the U.S. like all other countries worldwide, and many people had to spend their savings to survive difficult times. But for those who didn't have any savings or an emergency fund, were left with no choice but to use credit cards, which has led to a huge increase in consumer debt. Fact is, guys, that many households are struggling to make ends meet, and with unemployment benefits ending across many states, there's still many of those that are out of work or living on reduced incomes that may have had to give up their debt repayment plans to focus on more immediate needs. So if you've been relying on your credit cards to carry you through this, that expensive interest is going to add up quickly. So again, if you had no choice but to use your credit card excessively, then try to pay back the debt as much as possible to avoid additional interest rate payments. Another recommendation is to avoid keeping excessive amounts of money in savings. Now, you should always have a 3 to 6 months emergency fund and more if possible that is accessible, and that's not what I'm talking about in terms of excessive amounts of money. Here's the thing, guys. Interest rates are so low on savings accounts that due to inflation, your money is losing purchasing power every single year. So I would highly encourage you to invest that money into something that's going to give you a higher return. And a great S&P 500 index fund is a nice place to start. The stock market outpaces the returns of standard savings accounts any day. The next thing you should consider is refinancing your home loan. Mortgage rates fell to record-breaking lows during the pandemic, but they're slowly starting to creep up as the economy continues to recover from the virus pandemic. Now, rates are still currently at historically low levels, but experts predict they'll rise to 4% this year, which means now's the time to act if you've been sitting on the sidelines about a home refinance. An estimated 14.1 million Americans have the opportunity to refinance and save an average of $287 a month, according to recent research from mortgage technology and data provider Black Knight. Now, another added benefit is that rising house prices offer homeowners an opportunity to leverage their home, their equity to fund home improvement projects, pay down other debt, or maybe educational expenses. Speaking of education, another great thing to consider is refinancing your student loans. Now, federal student loan payments are paused until October, but some prominent Democratic lawmakers, including Senator Elizabeth Warren and Senate Majority Leader Chuck Schumer, are pushing the president to provide more relief to borrowers and forgive up to $50,000 per person. However, those of you guys with debt from private student loans are still on the hook for your regular monthly minimum payment. And if you are one of those borrowers, here's my recommendation. Refinancing to a lower rate or shorter term could save you thousands in interest fees and shave years off your student loan debt. According to online loan marketplace Credible, refinancing could slash your interest rate by more than 2 full percentage points and adds up to substantial interest savings over the life of your loan. So my recommendation is to maximize your savings is to compare loan offers from multiple lenders to lock in the lowest interest rate possible. Now, in addition to everything we've discussed, I highly recommend you contribute to build and work on your credit score. While today's low interest rates make it easier to take out loans, you'll find it more expensive to borrow when rates do go up. So now's the time to work on improving your credit score to ensure you continue to be able to borrow at the lowest possible rate. I mean, boosting your credit score a few hundred points will make you a more attractive borrower to all types of lenders, from credit card issuers to those offering mortgages. Alright, so have you taken the necessary money moves before interest rates rise? Comment below what steps have you taken to use this situation in your favor. If you found value in the video, do me a favor and tap the like button and share it. It really helps to support and grow the channel. Don't forget to subscribe and turn on the notification bell as I'm posting valuable new content multiple times a week. Thanks again for watching, and until next time.